Welcome to this explainer. Today, we are diving straight into the hidden mechanics of something literally all of us use every single day. We stress over it, we trade our precious time for it, but honestly, we rarely truly understand it. We're going to unpack the evolution, the unspoken rules, and the hidden mechanics of money. Let's start with a bit of a provocative question to clear up a massive, and I mean massive, common misconception right out of the gate. Is money the exact same thing as wealth? Think about it. We throw these terms around interchangeably all the time, right? We'll say, oh, he has a lot of money or she's very wealthy. But economically speaking, are they actually identical? Well, as it turns out, money is completely distinct from wealth. Wealth is your overall net worth. That's your real estate, your stock portfolio, maybe a rare art collection, your fixed property, all of that. Money, on the other hand, is simply the highly liquid fraction of those assets. It's just the part you can immediately use as a medium of exchange. To put that into perspective, Elon Musk's wealth is in the hundreds of billions, right? But he doesn't literally have $1 billion in physical cash just sitting under a mattress somewhere. Money is really just one specific, highly functional tool for holding a portion of your overall wealth. By the way, the fascinating macroeconomic insights we're unpacking today, which, trust me, will fundamentally shift how you view the numbers in your bank account, are drawn directly from the teachings of the University of the Western Cape. Okay, let's jump into Section 1, Solving the Barter Problem. To really grasp what money is, we need to travel back to a time before it even existed. Imagine the pure, unadulterated friction of a barter economy. Let's say you're a farmer, you want a pair of shoes, and you have, say, half a cow to trade. You literally have to scour the town for a shoemaker who doesn't just have shoes in your size, but who specifically wants half a cow at that exact moment. Economists call this the double coincidence of wants. It is a massive roadblock. It makes doing business incredibly cumbersome and inefficient. Money wasn't just some shiny physical object they decided to use. It was a brilliant technological leap that completely bypassed all this friction. Because everyone agrees to accept money, that whole requirement for a double coincidence, it vanishes entirely. Which brings us to Section 2, the 3 functions of money. Now that we've solved that whole barter problem, let's break down the core functions that this tool absolutely must perform in our economy to actually be considered money. First and foremost, it acts as a medium of exchange, meaning it's universally accepted as a payment. Second, it acts as a unit of account. This is a big one. It gives us a universal measuring stick so we can accurately price an apple versus a tractor, and even measure massive economic outputs like the entire GDP. Third, it serves as a store of value. Think of this as essentially a way to time travel your purchasing power into the future. And finally, as a kind of bonus function, it acts as a standard of deferred payment. This is what allows credit to exist. It means you can sign a mortgage today and calculate exactly what you owe over 30 years in standard rands and cents. But we have to talk about a fatal vulnerability here. When high inflation strikes, money completely fails at its job. It loses its usefulness as a unit of account because nominal prices are constantly distorting, which just creates total chaos in the market. But more importantly, it becomes a disastrous store of value. It essentially melts your real purchasing power over time, failing to protect that wealth you've tried so hard to time travel into the future. Moving right along to Section 3, from commodities to credit. Tracing the evolution of this technology is absolutely fascinating. For a monetary system to be efficient, the tool needs to be durable, portable, and divisible. So we started with literal cattle and chunks of silver, eventually moving to antiquities mixed metal coin systems. But as you can imagine, lugging around bags of heavy metal was dangerous and just incredibly impractical for large trades. Enter the goldsmith era. People started leaving their gold in secure vaults and simply trading the fully backed paper receipts instead. Much easier, right? But then came one of the biggest aha moments in financial history, the transition to the fractional era. Goldsmiths realized that, hey, not everyone comes to claim their physical gold all at once, so they started issuing more paper receipts than the gold they actually had sitting in the vault. They literally created fiduciary or credit money out of thin air. Fast forward to today, in our modern era, fiat banknotes aren't backed by gold at all. They run purely on our collective confidence in monetary authorities. And now, we're pushing even further into the digital age with electronic payments and the algorithmic scarcity of Bitcoin. Next up, Section 4, Measuring the Money Supply. Since modern money is largely based on confidence and credit rather than, physical gold in a vault, it brings up a really fascinating question. How do central banks actually count all this invisible credit money? Well, economists build their measurements layer by layer, categorizing money by how quickly it can be spent. They start with M1, the highly liquid stuff. This is the physical cash in your wallet and your immediate bank balances, money that is ready to be spent right this second. Then they step up to M2, adding short and medium-term deposits. This introduces what economists call quasi-money, funds that are safe but require a little bit of time or a small penalty to actually access. Finally, they reach M3, the most comprehensive measure, which includes M2 plus long-term deposits, fully capturing money's role as a broad store of value. To see how this maps to the real world, take a look at the liquidity column in this breakdown of the South African monetary sector classifications. Watch how the liquidity naturally decreases as we move down the tiers. M1 is immediate, it's your cash and checking accounts. M2 drops that liquidity slightly by including deposits that might be tied up for up to 6 months. And then M3 drops liquidity to its absolute lowest point by adding deposits locked away for over 6 months. By layering it exactly like this, central banks get a truly complete, comprehensive picture of the wealth parked in the entire financial system. So why does categorizing all this actually matter? Well, for monetary authorities like the South African Reserve Bank, that M3 metric is the ultimate gauge. By tracking this comprehensive measure, they can evaluate whether they are actually successfully controlling inflation and stimulating economic growth. These are the massive macroeconomic decisions that eventually trickle all the way down to dictate the interest rates on things like your car loan and your mortgage. Finally, let's wrap things up with Section 5, why we hold money. Let's connect all this high-level macroeconomic theory directly back to you and your wallet. At a fundamental level, your personal demand for money falls into 2 distinct buckets. The first is transactions demand. You need liquid cash simply to live, right? To buy groceries, pay for coffee, keep the lights on. The second is asset demand. Now, this is a deliberate choice. You are actively choosing to hold money purely as a convenient liquid store of value. You're parking your wealth in cash for the future rather than tying it up in less liquid, fluctuating assets like real estate, stocks, or long-term government bonds. Which leaves us with a final, rather provocative question. Think about your asset demand for a second. Factoring in the silent compounding theft of inflation we discussed earlier, combined with the opportunity cost, meaning the interest you are actively forfeiting by leaving funds in a stagnant account, exactly how much is holding on to safe liquid cash truly costing you every single day? Honestly, it's a calculation you absolutely need to make.